Great. We are on, and I have great pleasure in having Karim today. Karim is general partner at Luge Capital, and we're going to be talking to Karim about a whole lot of wide areas in fintech. But before we do that, welcome all. My name is Kanchan Kumar. I'm co-founder and CEO of a payments company called Remitter, but I'm here not wearing my Remitter hat. I'm wearing my Remitter t-shirt, but I'm here as a volunteer of TIE Toronto. TIE Toronto is a volunteer-driven organization focused on entrepreneurs. We are the world's largest not-for-profit organization with a single-minded focus on fostering entrepreneurship based on 4 pillars: education, networking, mentoring, and investing. Education is what we are really being focused on in this season, fall season. We have done several programs around education. We have got experts to tell you about product, about metrics, about how investors look at businesses. We had Stephanie coming and talking about her experience of fundraising and multiple rounds of fundraising, all of that. And of course, next year, we have a lot more planned. TIE is run by entrepreneurs and professionals who believe that the world is changed by entrepreneurs. And people like you, people like us, we make the attempt, we come together to help this grow. There are 2 kinds of members. TIE Toronto has it, TIE Associate members, which is open to all, $100 per year. This is for anyone who's interested in entrepreneurship, no qualification criteria. The other is TIE Charter members, which is by invitation only. This is open to investors, seasoned entrepreneurs, executives, professionals who come together not just to financially support the chapter and run events like this, but also to provide their time and effort and open their network to help entrepreneurs grow their businesses or start businesses. And in this regard, we have done many such programs, but one of the programs which are really powerful and popular, this program has been running for more than 10 years. I forget in how many years now it is running for. It's called TIE Quest. Every year we run a program where we call for early stage entrepreneurs which already have a business to come and participate in this. You apply to a multi-stage business venture competition. At the end, 5 finalists get all the limelight. They, of course, each one gets a membership of TIE, but most importantly, you get critical feedback about your businesses from experts and mentors. Top 5 participate in a final round where one of you will go and win up to $25,000 in prize, in cash prize, $100,000 in investment. And most importantly, you get access to the TIE Global Network. TIE Global Network spans across 18 chapters, 61,000 members, which will open the door for you to expand your business globally. The link is there for you to apply. Application is open, and it's open till 31st of January. And before we start, just to recap, these are the kind of events that we have done so far. Mike hosted the first event on priority mapping, on product management. Alex did an event around how VCs have started looking at businesses differently during this period. Mark Evans spoke about storytelling. Philip Gaze spoke about startup metrics. We had a wonderful session where we had Stephanie share her journey of fundraising and pre-seed and beyond. Jeff brought together the 5 finalists, past 5 finalists and winners of past TIE Quest competition to talk about their journey. And we have some extremely good conversation there. All the videos are up there on our TIE YouTube channel. You can go and watch them. And now it's time for Karim. Welcome, Karim, again.
Thanks, Kanchan. Appreciate it.
Karim, first and foremost, you have varied experience. You started out doing what? Engineering, went into do a law and economics, and then you worked with BlackBerry, and then you got into payments, and then you became a VC. Can you tell us a bit more about this really zigzag journey that you have really had?
Yeah, sure. Yeah, that's exactly what it was, a zigzag journey, unplanned, entirely unplanned, almost all by accident. But first, I just want to say thank you for having me, for hosting me here. It's a pleasure. It's always good to see you and to chat with you. So I'm grateful for that. By the way, you chose a good picture. I look a lot younger in my picture then than I do now. I look like an old man now with a beard. So thanks for choosing a good picture. um, but yeah, so my background, it's kind of a strange one, like you said. By training, my background is in engineering, finance, and law. Um, I kind of started off as a software developer. And a long time ago, I wrote some of the original code behind what is now Interact's e-transfer product. And so I went through software development, went through product management. I also went through architecture design. So I used to design telecom networks for mobile carriers in East Africa and Western Europe. And somewhere along the way, I started moving further and further away from my engineering roots. I picked up a finance degree. I majored in economic policy, and I moved into a business development role. I came back to Canada, so my telecom architecture role was in the UK. I got a call from a friend who said, "Hey, come back to Canada. There's this new emerging company that builds phones with keyboards on it called BlackBerries." And so I joined BlackBerry to help with the business development practice. And so I helped grow this team. There was 2-3 of us. We helped grow the team to about 25 people, and we were doing all of the strategic partnerships for BlackBerry at the time. And we stood up BlackBerry's application store, their version of the App Store called BlackBerry App World. And then I sort of did a whole bunch of payments related stuff, P2P payments and mobile commerce, and NFC was one of the big projects I worked on at the company. And then I moved out to California. So I went out to San Francisco and I started working on M&A and venture investing for BlackBerry in the Bay Area. And so my job was to look at new companies that we could acquire, bring their technology in-house to the company, and then integrate them to make the offering better. And then I think it was in 2012, I left BlackBerry and joined a small company in San Francisco called Zoom. Not this Zoom, but Zoom with an X that specialized in cross-border payments. And I joined to run the business development practice there, ultimately started corporate development there, helped take the business public, and then ultimately helped sell the business to PayPal in 2015. And then I ran our M&A and venture investing activities for PayPal in Canada for a few years. And then in 2018, almost by accident, started up this fund called Luge Capital, which today is an $85 million early stage fintech focused VC fund. I'm based in Toronto now. I've got a partner, David, who's based in Montreal. We have a team of 6 people, and we invest across Canada and the US, all early stage fintech. So I know I said a lot, but it's like you said, it was a zigzag journey to get to where I am today.
And quickly, would you also tell us as to what Zoom looks for in the companies? What kind of companies you invest? What's your typical check size?
Yeah, so at Luge, we, like I said, we're early stage investors. So we typically look for companies raising seed or Series A stages of financing. We have done some pre-seed in the past, but our real focus is sort of seed and early Series A. We will invest as little as $150,000 on the really, really low end. That's unusual though. But we'll go as high as $2 million for more mature companies. And our sweet spot is about $1 million to $1.5 million. And we often look at ownership levels of kind of between 10 and 15%. So that gives you kind of an idea of the stage relative to the check size. And I think I mentioned before, our arena is really Canada and the United States.
Awesome. And that's why you're here, because I wanted to get your perspective on the fintech landscape in Canada and United States in particular. Now, as with every digital service, pandemic has brought about quick adoption. But there are some fundamental changes also that we're seeing in various different business models, various different industries. Some industries have completely gone away, or the companies have gone away, which will possibly take quite some time to build again, and newer ones have emerged. What have you seen, which has been, according to you, of more interest from a early stage entrepreneur's perspective that pandemic has brought about?
Yeah. Well, the interesting thing is that the pandemic, it forced everybody to go back inside. It forced everybody to stay at home. It meant you couldn't interact with businesses in person. And really stemming from that, it means that these large corporations needed to figure out their digital strategy. And what I mean by that is, for those companies who rely on traditionally manual pen and paper or in-person interactions, they saw a big clip in their business. And so they had to react relatively quickly to figure out how they can service their customers in a truly digital environment. And I don't just mean partially digital, as is the case for some industries, but I mean truly end-to-end onboarding and servicing your customers, either on your mobile phone or on your desktop. Fintech, I know you had one of the questions on the earlier slide, why is fintech so hot? Fintech or financial services makes up about 1/5 of our economy. It's about 20% of our GDP, which is phenomenal in terms of size. And included in that figure are insurance companies, banks, real estate companies, and all of these industries in their traditional form rely in some shape or another on manual processes. Think about how you open up a bank account. Think about how you buy life insurance. Think about how you apply for a loan or try to get a mortgage for a new house. Very often it requires you to be in a branch or talk to a live human, sign a piece of paper with a physical pen. And we now live in a world where those things are not possible. You need to be able to open up a bank account in a truly digital world. You need to be able to buy life insurance in a truly digital world. And so I think this pandemic was really a digital reality check, if you can call it that, for a lot of the incumbents who relied on these sort of manual or in-person interactions.
And that really opens up opportunity, as you mentioned, for reinventing a lot of these processes for banks and financial institutions, the traditional ones, but also possibly creates opportunity for the newer companies to come about and disrupt, right? Have you seen any trends in that, in newer opportunities emerge?
Yeah. So one of the benefits of pushing everything into a digital environment means that a lot more is data driven. In other words, there's more data being collected about user behavior. There's a lot more insight that can be gathered from, a user's experience with a particular business or service provider. And so what we're seeing is the onboarding experience, for example, is becoming more and more simplified or seamless when you're thinking about, in this case, we're talking about financial services. If you think about, being onboarded for an insurance product, insurance companies are now building these user flows where you can not just get a quote, but also go through the entire flow to provide your information and be bound to a policy at the end of your session. And you can do this all on your mobile phone through an app or through a mobile website, whereas before, in most cases, you would have been required to pick up the phone and call an agent to complete that process. Nowadays, we're seeing more and more companies being able to do that entirely digitally. Fraud management or fraud mitigation is another area where we're seeing growth and innovation. Especially claims fraud. A lot of the insurance companies saw a big spike in insurance claims as a result of the pandemic, and a lot of those claims are legitimate claims for people who are in need and are suffering. But it's unfortunate there are many cases out there where that's not true, and people are trying to defraud their insurance companies. And so insurance businesses are starting to pay more and more attention to that and trying to figure out new tools, leveraging artificial intelligence to recognize patterns, say, okay, this seems like it's not a legitimate claim. So those are, examples of kind of new innovations that we're seeing. One of our portfolio companies, Senso, is predicting when a customer is about to churn off of their mortgage and helping their financial institution customers retain those customers. So Ken Chan has a mortgage with his bank. He is, for whatever reason, unhappy with that. Senso is a tool that can inform the bank, hey, this is what you can do to save Ken Chan as a customer. That could mean, offering him a better rate on his mortgage. It could mean offering him a better credit card as well, giving him a discount on his wealth management services, and a slew of other things to help retain him as a customer. All of this is kind of data driven, based on a fully digital environment.
Also, we have seen in US in particular, for example, SBA loan disbursements have been a major challenge for a lot of large banks. And that is where a lot of smaller banks and fintechs have really come forward, right?
Yeah, yes. We saw, earlier on in the pandemic when the government was trying to disperse a bunch of capital to help stimulate the economy, like, that, the institutions sort of fell down because it was unprecedented, the amount of capital that needed to be pushed out. And how do you build process around that in a way that you're ensuring that the recipients or the beneficiaries of this capital actually deserve it because they've been affected by the pandemic, and build processes around tracking it. And so the incumbents you saw fell down in that process because they weren't built or designed to do it. But the sort of new age tech companies who are built to do something like that were able to do it a little bit more efficiently. So that's just a great example of where if a situation is unprecedented or unanticipated, the old legacy systems often can't handle it and will fall down.
Yeah, I think the another example which comes to my mind is refinancing of mortgages. Like I was reading some stats which said that this is unprecedented. In the shortest possible time, the amount of or the number of mortgages which have got refinanced, it has never happened in the history. That in the period of like 3 months, just about everyone was looking at refinancing, and financial institutions were not ready for that kind of a load.
Yeah, that's right. And we have very, very low interest rates right now. And that's a big driver. I mean, our interest rates were low for a while, and then they started climbing up. And then when the pandemic became a problem, we know that the central bank lowered interest rates again to help stimulate the economy. And that, of course, has macro level effects across different industries. And mortgage refinancing is just an example of that. You know, you're right. There's refinancing of mortgages has hit record numbers in the recent past because of this very, very low interest rate environment. And what we're seeing actually, and I mentioned Senso, and I'll mention them again because it's relevant to this topic. As people are refinancing, they're looking for the best deal, which means that they have higher propensity to churn from their existing mortgage provider. And what's interesting is in Canada, actually, the retention rates on mortgages are you know, relatively high, something like 75, 80%, maybe even higher than that, of mortgages are retained at the same institution. But that number in the US is way lower. It's something like 20% of mortgages in the US are retained by the same lender. And what that means is that the vast majority of mortgages in the US are slipping away from that lender to somebody else who's willing to offer a better deal. And so if you think about refinancing because of lower interest rates as a motivation, that just perpetuates the problem even more for those institutions who are trying to hang on to that business. And so it creates an interesting dynamic. You know, consumers have an opportunity to win out in the sense that they have an environment where they can get cheaper money for their mortgage. But the financial institutions who are trying to serve them are struggling to retain them because of this very fierce competitive environment.
Now, going forward from this, if you look at the lending, how do you see the lending landscape unfolding? Because it's really challenging, right? On one hand, if you have lent to businesses which are struggling to survive, then how do you recover? On the other hand, it's a low interest rate regime, which basically means that the margins are thin as well. So how do you see the lending panning out over a period of time?
Yeah, and this a good question. It can actually be a very complicated question depending on how deep you want to go, because the lending environment will affect different entities differently. And what I mean by that is if you're a struggling business and you need some extra capital to stay afloat and survive the pandemic, your prospects for capital are significantly lower than if you were a thriving business that were feeling tailwinds because of this pandemic. And so if you're talking about traditional capital by getting a bank loan, for example, can be very expensive or just not accessible to you. And if you're talking about alternative lenders, again, you run into a situation where it can be very, very expensive, which feels incongruent in a low interest environment, right? And that's part of the reason why the Canadian government and earlier this year the US federal government was trying to push out capital to these small businesses to keep them afloat, because they knew that the accessibility to capital for them was not very strong. Now, that said, there are a handful of businesses that kind of fit in this sort of gray zone. They're not obviously doing poorly and they're not obviously doing well. They sort of fit in this zone where it needs a little bit of attention. And typically the traditional lenders don't have the capability to assess credit worthiness if you're in this sort of gray zone. And that's where some new technologies are emerging to help these lenders, particularly alternative lenders, make more sort of credit-worthy decisions, because of course, if you're a lender, you're motivated to lend money. That's your business, right? And you want to do as much as you can to prevent your business from lending money to those who are not worthy. But you start with a propensity to lend as opposed to a propensity not to lend. And so we're seeing that, again, not to spend too much time on our portfolio, but one of our companies, Flinks, works very, very closely with alternative lenders because they are providers of data, financial data, that allows these lenders to look at the financial history of a company or an individual so that they can make a credit-worthy assessment, say, yes, Kanchan, or yes, your business is worthy of taking capital at a relatively affordable rate. So that's one thing. And then, there's another nuance or a completely, other side of this coin is that lenders, particularly institutional lenders, are finding themselves operating in a low interest environment. And so that means, they're looking for other more sustainable, higher yield products to invest in besides just providing straight up debt or sort of low risk investing in the marketplace. So that's we're seeing a lot of very new creative securities being created for investors to park their money and still get a relatively high yield versus, let's say, the bond markets.
Awesome. So switching gears, I want to talk about this whole movement, if I may call it, which is building up, called embedded finance. Financial services being available as API, banks coming up, or newer banks coming up, or even existing banks now more willing to become wholesale provider of those regulatory coverages which are required by fintechs, and which basically lends itself very well to a lot of different businesses embedding financial services features in their business. So for example, you could be a business cash flow management product software. It could be a SaaS tool which could possibly build a lending into that, which is actually not your lending product, but it just gets embedded in your workflow. You could be an invoicing product and you see various kinds of payment features being built into that because now that's available as API. What's your view on this? How do you think that's going to pan out in terms of opening up opportunities for typically non-financial services businesses to embed financial services in their core product features?
Yeah, I think the key here is accessibility. If you think about a world where you wanted to start a business and start accepting payments, which is really the core of running a business, getting your customers to pay you. 10 years ago, 15 years ago, that was hard to do. Just accepting credit cards as a form of payment on a website or in a physical store is actually very complicated if you were to try to do it 10 or 15 years ago. Now it's almost trivial. I mean, if you think about how Stripe works or how PayPal works, it's almost not even a topic you spend mind share on because it's trivial to do. And so I see these sort of banking as a service platforms paving this path to allow, just as you say, these sort of non-fintech focused companies to start providing sort of fintech or financial services type products that you otherwise wouldn't associate with that particular business. So the key in my mind is this level of accessibility. I think it's not perfect yet, but we're certainly on that path. And you hear about companies like Galileo or Synapse. There's a new small one in California called ProductFi. Stripe, just launched a new product in this category. Not to mention all of the sort of new age banks that are offering these kinds of services, where, to your point, you can offer payments or credit or a buy now, pay later product embedded in your experience that's outsourced to somebody else who manages the entire back end of it and the compliance, and you manage the user experience. So I think we're on that path. It's not perfect yet. There's still a bunch of hiccups to navigate, but we're getting there. I think in the next couple of years it'll be a lot more seamless.
And I think we've already seen, for example, the Stripe Treasury announcement, and before that, Shopify had announced Shopify Balance as to how they're going to. So we have Shopify, which is the e-commerce platform, but also neobank. We have Wave, which is invoicing and accounting, and also a neobank. We have QuickBooks in US, which is obviously accounting, but also a neobank, which is all powered by these APIs. Are we going to look at like hundreds of neobanks? What's your view of it? Where is this headed?
Yeah, it's funny. We I don't know if I should tell you this, but it's funny. We used to see so many challenger banks come in our virtual door at Luge. We almost made it a drinking game. Anytime somebody pitched us a neobank, you'd have to take a shot. And so you're right. Like there's so many of these challenger banks popping up, and a big driver for that is because this infrastructure exists in such a way that setting up a challenger bank is a lot easier to do today than it was 5 years ago or 10 years ago. The concept of a challenger bank 10 or 15 years ago just didn't exist. It's still non-trivial, but it's a lot easier to do, and that's why we see them. If you're asking me what's my point of view as to what the future of challenger banks look like, I'd say there's a handful that pull away from the pack and become relevant and meaningful, and we're seeing that with Chime, and to an extent Current, and then there's Dave, and like Revolut are some of those ones that we know well and have grown significantly. And then there's a massive long tail, and we think in order to be successful, there needs to be something that is particularly differentiated about the offering. And the two areas that we actually think have meaningful opportunity ahead of them are banking products for kids. And I'll explain more about that in a second. And the second one is banking products for gig workers, or the gig economy. I think there's actually a third category I would call out for banking services for SMBs, because SMBs are not properly served by the traditional banks. But if you think about kids, like kids, you turn 10 or you turn 12, you open up a bank for the first time, 9 times out of 10, you go to the bank where your parents bank. If your parents bank at B of A, that's where your kid gets a bank account. And so that means that these traditional banks have not invested a lot of time and energy into building products for kids, because parents are acquiring them for free. And so, we invested in a New York company called Till, who's focused specifically on building products for kids, banking products for kids. So you get a stored value account, you get a debit card, mom and dad have some parental controls, grandma, grandpa can contribute so that you can save for the new bike or save up for your college education. But it's really important because this is your very first experience with managing your finances. So that's where we see a lot of opportunity. And the second one is gig workers. Gig workers don't traditionally have access to benefits, health and dental and vision. And so we think there's an opportunity for these benefits to be the anchor of what drives a financial services experience for the gig economy. So again, big long tail. We think that those 2-3 things are the ones that have meaningful opportunity. Yeah.
And this brings to the very obvious question. On one hand, we have all of these new neobanks coming up, challenger banks coming up. They are typically tech companies, startups, which are hungry, which can think differently and bring out a newer product, or that's what they are trying to or hoping to. On the other hand, we have banks which have suddenly realized that they need to project a different image, project a very digital friendly new age image. And many of them have started calling themselves a fintech of banks. And we've seen different countries and different banks behaving that way. And then on the third side, the interesting thing which we see is these big tech giants. And suddenly they have come up and become a major player almost overnight. Google Pay has become, WhatsApp has become, not in this part of the world, for example, India and Indonesia, WhatsApp payment is a big thing. Apple came up with their Apple Card, and now they've gone into, or they're possibly going to get into the card acquiring business with MobiWave acquisition, all of that. Now, where does that leave a small early stage startup trying to make a dent in this entire space where suddenly all the big guys have started and flexing their muscles?
Yeah. The short answer is there's lots of opportunity. And so if there's guidance to be given to anyone who's a small fintech company, I would say steady the course. There's lots of opportunity. And what I mean by that is, look, there was a world many years ago where the fintech companies and the banks were at odds with each other, and the banks felt like, hey, these new emerging fintech companies are coming for us. They're going to try and eat our lunch, and we're going to do what we can to push them away or to crush them. And that mentality has done a full 180 in the sense that traditional banks and insurance companies are now actually actively working with fintech companies in a big way. And our existence as Luge is an example of that. I mean, we are a venture capital fund that invests in small fintech companies. Our investors in our fund are big institutions. They're Sun Life and Desjardins, Industrial Alliance, Luge Capital. Like, these are large banks and insurance companies who have entrusted us with their capital so that we can invest in these early stage fintech companies. And a benefit of doing that is that they get access to these companies so that they can work together in collaboration. So the fintech companies and the big institutions are actively working together on projects, and almost every single company in our portfolio is working with at least one, if not many, large institutions for some kind of a partnership. So that's point number one. The second point, you mentioned these big tech giants, and there's, throw them into the mix, and what's going on there. And my take on it is that these big tech giants are actually very well positioned to become disruptors in financial services. And why wouldn't they? I said before, financial services is about a fifth of our economy. It's roughly the same in the US as well. And so they have a captive audience. You think about Apple. Apple has hundreds of millions of customers who are using their devices every day, and they require those customers to store a credit card with them so that they can get access to the Apple App Store. Amazon, same thing. They've got hundreds of millions of customers making purchases on their site and through their mobile app every single day, especially during the pandemic. They've got hundreds of millions of credit cards on file. They are perfectly positioned to start leveraging that relationship to offer things other than a mobile phone in the case of Apple, or a book or a T-shirt or a pair of glasses in the case of Amazon. And that's why Apple launched Apple Card. It's a further driver of developing the relationship with their customer. Once you have financial services with that customer, it becomes very, very sticky. And if you make it a seamless user experience. You double tap the side of your phone twice, or you use facial recognition to pay with Apple Pay. Like, you can't get easier than that. And so the reason why I think these guys have a real shot at making a dent is because they're perfectly positioned through their existing relationships with the customer. So it's not surprising to me that these big Silicon Valley tech giants are starting to make more and more of a play in this space.
Awesome. I have many questions, but I would open this up for the audience to ask questions. Here's our first question. Someone asks, is Luge Capital willing to enable portfolio companies to grow in other faster growing markets like Asia, or are they focused more on Canada and US only?
Yeah, this is a great question. So our philosophy as fintech investors at Luge is although we invest in companies that are domiciled in Canada and in the United States, we always take a global perspective when we make an investment. And what I mean by that is we look for investments, or we look for companies where they have a strong potential to become global players. And that can manifest in a number of different ways. First of all, it manifests in the culture of the company. Do they have the ambition to be the best in the world at what they do? But it also manifests in the way they build their product. Is their product multilingual, multi-currency? Is it adaptable to local regulations in different parts of the world? Has the engineering and product teams thought about, will this comply with regulations in the UK and in Australia and in the US and in Canada and in Germany? And if not, why not? Like, you should be thinking about scaling your platform and building for that inevitability. And it also comes in the form of business development, where you go and acquire your customers, and where you choose to go and get licensed for compliance purposes. So like I said, we invest in Canadian and American companies, but always with a view that they will expand globally at some point in the future.
Great. The next question comes from Kumar. He asks, given so many startups in any given space, how do you decide this is the one?
This is probably the single most difficult question you could ask a VC. And the reason why I say that is because so much of being an investor is making the decision to invest or not invest. And there's just a ton of factors at play when making that decision. But that's really what it comes down to, is the ultimate decision. Should I invest? And then the next question is, how much should I invest? And look, for us, we try to be very thoughtful about the investments that we make, and we try to look at a number of different factors and do our diligence properly. Every investor will tell you that the team is one of the most important, if not the most important thing to look for. The character, the integrity, and the caliber of the founder and the founding team is incredibly important, because as an entrepreneur, you are going to experience difficult times, and you only have your wit to rely on to navigate through those difficult times. And if you don't have that, it can be catastrophic for the business. So the team is really important. Of course, the market opportunity that they're addressing is really important, which is really a statement about whether the company is solving a big problem or not. And then is the solution that they're building for the problem the right one? And of course, are they the right team to be building that particular solution? And then another factor is timing. Is the market ready for this particular solution to be deployed right now? Is it too early? Is the market not yet mature for this kind of a solution, or is it too late? Are there a ton of competitors already doing it, and this is just going to get lost in the noise? Those are all very, very big factors that get us closer to making a decision. And then there are a whole bunch of other things. I mentioned how the tech platform is built. Is it multilingual? Is it multi-currency? What does the cap table look like? How much ownership do we think we can get on an investment like this? How much return do we think it can provide to our fund? And then there's a bunch of other stuff that VCs often don't talk about with entrepreneurs, like, in a life of a fund, which is generally 10 years long, you might be willing to take more risk at the beginning years and invest in early stage pre-seed companies where it's, two founders and an idea. Whereas in year 3 or 4 of the fund, you're looking for more mature companies to invest in because your horizon to generate a return is a lot lower. So these are all very nuanced factors that go into it, but it's the single most difficult question you could ask a VC.
Thank you so much. Before I take a next question, I have a question. And that question is about VC industry itself. Now, VC industry is also financial services business in a sense. You
Sure.
get money, you give return, right? Do you see that changing with technology? Do you see a fintech coming in and disrupting a VC industry?
Sure, it's already happening.
Mm-hmm.
Venture capital is is probably one of the most archaic industries in and of itself, in the sense that it's been around for a very, very long time. And in terms of actually how a venture capital fund is run, it's, in some sense, it's very inefficient in terms of the tools that we use. But the model is very old, and it's already being disrupted. Andrew D'Souza and Michelle Romano are good friends of mine. They run a company called ClearBank, and their whole mission in life is to fund entrepreneurs who are running businesses where the economics for venture investing doesn't work, or they don't have accessibility to venture, or they are making the process of providing capital to these entrepreneurs much more efficient and faster. If you come to me with a company, it's going to take me some time, me and my team some time to evaluate your whole business and come up with a point of view before I actually put dollars in your bank account. And a company like ClearBank has this 20-minute process where they'll use their algorithms to make an assessment on whether your business has very good prospects, and they'll put money into your bank account same day. So it's already being disrupted.
Awesome. And I'll again now take your audience question. The first question really is from Joe. Joe is asking, can you give an example or two of how you connect your portfolio companies with your LPs and investors? Is that something that you do it often? And if there's an example for that?
Yeah, actually, this is a core part of how we operate our fund. So all of our LPs are listed on our website, so anyone can see who they are. But a large handful of our LPs are quote unquote strategic in nature. And what I mean by that is they're banks or insurance companies or pension funds. And a big part of their motivation to invest in our fund is not just financially driven. In other words, they're looking for financial returns, but they're also looking for access to the deal flow that we see, and more importantly, our portfolio companies. And so, one, we get a lot of insight from our LPs and in terms of how their business operates, so we can use that as a lens to assess companies. But once a company is in our portfolio, we work with our LPs on partnership opportunities. So I think I mentioned before, almost every single one of our companies in our portfolio is working with a big institution in some form for partnership, in most cases, those big institutions are an LP of ours. And so, I mentioned Sun Life and Desjardins and Luge Capital Industrial Alliance. They are highly motivated to innovate their internal processes, build out new technologies, and work with these fintech companies to streamline their business. And our portfolio represents a way to do that.
Yeah. The next question is about, again, from Joe, is on, let me just move this. Sorry. I am really sorry about this. Yeah. And the next question is about fintech, which requires large amount of working capital, particularly in the area of real estate transactions. Do you have a comment on that as to how do you deal with that?
So I'm looking at the question. I'm not sure I fully understand it. Need to deploy large amounts of working capital as part of their offering. So I'll try to bifurcate the question. We've got a particular thesis around frictionless real estate that's published on our website. And the idea here is that today, the experience of buying real estate, particularly residential real estate, is very cumbersome. It requires a buying agent and a selling agent and a lawyer and an appraiser and a lender and a broker and all these different parties that are involved. And it's usually orchestrated by the buyer. And it's a very, very involved process. And we believe that the real estate buying experience should be a lot more frictionless compared to what exists today. In other words, I should be able to find the house that I want, say to my agent or, a technology platform, this is what I want. Go and find me the best lender with the best rates, the best terms. I want the walls painted blue and the countertops changed, and I want to put new tiles in the kitchen. And I want this closing date. By the way, also take care of selling my current home and take care of moving all of my stuff from my current home into this new home, and call me when the keys are ready. That's the kind of experience that we think should exist in the world. And we see a lot of very siloed versions of that, or companies focused on one or a couple of those problems, but we think it should be more holistic in nature. And then I think the second part of the question is, how do we view fintech companies that need to deploy large amounts of capital in order for their model to be sustainable? And I guess the answer to that would be, it depends. It depends on the business, depends on the nature of the capital that's being deployed. If it's an alternative lender, we have this view that alternative lenders who are borrowing money to then lend money need long-term access to sustainable, cheap capital in order for their business to work. And that's not an easy thing to achieve. And then if you're talking about, a company that's buying up a bunch of real estate, I'd want to understand, well, what, as investors, what would we be investing in? Is it the real estate assets that are being held by the company that acts as sort of security on the investment, or is it the tech platform? And we're tech investors, and so the multiples that we see on tech investments are very different than the multiples or the economics we would see on buying and holding real estate as an investment portfolio. So, I'm not sure if that answers the question, but it really depends on the nature of the business.
And I think you, as you rightly pointed out, like any other alternate lender does, this possibly is related to a equity and a debt transaction. Like any alternate lender, they would raise equity to build the business, to acquire customers, to build the technology platform, credit rating, all of that, while they use either someone else's book to lend from, or there is debt to lend from. I think what we're seeing here is a very similar requirement where the capital to buy possibly comes as a debt. That's what I could understand, but I'm sure when we know more, we would understand, right? Great. The next question is, do you use psychometric tools to assess capabilities of founders?
This is a good question. I've got this question before. For us, we try to take as much of a data-driven approach as we possibly can. But being an early stage investor, we often don't have access to a ton of hard data as a way for us to make an assessment. Like, we can look at companies' revenue metrics or their P&L KPIs, but very often they're either non-existent because they've just launched, or they're about to launch and don't have the traction, or their traction is so small that it's not statistically relevant, or it is relevant or it is meaningful, and then it becomes a big portion of how we assess the company. But generally, if you're talking about seed stage or early Series A companies, you don't have a ton of data to go off of. And so that's where you rely on the pedigree and the experience of the founders, how they've behaved in the past in tough situations. Are they solving a big problem, addressing a large market, things like that. Certainly talking to founders and doing diligence over Zoom has been a challenge in a pandemic-stricken world, because we don't get to see the sort of soft signals or the qualitative signals that we would ordinarily see when we spoke to a founder face to face. And what I mean by that is sometimes you'll ask a question, and if founder squirms in his chair or her chair, that's an indicator. That's a signal for us. If you ask a question on a Tuesday and you ask the same question on a Thursday, do you get the same answer, or is it slightly modified? And those are not scientific methods. Those are more art forms to try to pick up on different characteristics. But all of those things are signals for us when we look at investment opportunities.
I think, knowing a whole lot of investors and friends, I believe that investing is a lot more people business than it is thought of.
Yeah.
I think people like you who are investing, and we have taken investing as a profession, have also taken reading people as a profession.
Yeah, that's right.
Yeah,
that's right. And particularly at the early stages. Yeah. I mean, when you're talking about investing in a company's Series B or Series C or beyond, you can rely a lot more on the data that they've been able to produce over the years as a key factor in decision making. But at the early stages, we just don't have that data available to us. So we are relying on qualitative data in a big part.
Great. And the last question is, what's more interesting for you? Is it a company with high transaction, low margin, or low transaction, high margin?
I'm going to give an unsatisfying answer, and that is, it depends. It depends on the business. I mean, we've got high volume companies in our portfolio. We've got low volume companies in our portfolio. We've got companies that are generating revenue based on transactions. And so they look at X number of transactions per month and a take rate on that as the way they grow their top line. And then we've got B2B companies who are selling large enterprise tools to banks, and they'll sign on 1 or 2 customers per quarter, who individually represent tens of thousands or hundreds of thousands or millions of dollars of revenue on a per contract basis. So we're open to both models. I think the key thing to think about is whether the revenue is quote unquote high quality revenue. In other words, is the revenue long-term sustainable? Is it repeatable? Is it something that will help drive the business, or is it one-off revenue that will eventually go away or erode, and it's not actually contributing to the growth of the business? So I think it's really more a matter of quality of revenue as opposed to the form of revenue.
Thanks a lot, Karim. Thank you for all the time that you spent answering these questions and some insights that you drove today. It's
my pleasure.
It's always a pleasure talking to you, Karim.
Yeah, likewise. Absolute pleasure for me as well. It's always great to see you and talk to you, Kanchan.
And thank you everyone for the session today, attending, and your time and your questions. As I mentioned earlier, TiQuest applications are open. Please go ahead and apply. This is a very high quality venture competition. And if you have any doubts, go and check the past winners and finalists. The videos are there on YouTube, and you would see the kind of people who have won and what they've achieved by participating in TiQuest. Thank you so much, and have a great rest of the week.
Great. Happy holidays. Thanks, everybody.
Thank you so much. Bye-bye.